Demystifying non-resident rental income taxes in Canada, expert insights unveiled. As an expert content writer, I have crafted a comprehensive article on the topic of non-resident rental income tax requirements for Canada. Understanding non-resident rental income tax requirements in Canada. When it comes to owning rental property in Canada as a non-resident, understanding the tax implications is crucial. Non-residents who earn rental income from Canadian properties are subject to specific tax regulations outlined by the Canadian Revenue Agency, CRA. One of the key provisions that non-resident landlords need to be aware of is Section 216 of the Income Tax Act, which sets out the rules for reporting and paying taxes on rental income earned in Canada. The importance of Section 216 tax. Under Section 216, non-resident landlords are required to file a Canadian tax return to report their rental income. This allows them to take advantage of certain tax benefits and deductions while fulfilling their tax obligations in Canada. By complying with Section 216 tax requirements, non-residents can ensure that they are in good standing with the CRA and avoid potential penalties for non-compliance. Non-resident rental income tax obligations. Non-residents earning rental income in Canada are generally subject to a withholding tax rate of 25% on their gross rental income. However, under Section 216, non-resident landlords have the option to file a Canadian tax return to report their rental income and expenses. By doing so, they may be eligible for a reduced withholding tax rate based on their net rental income. It is important for non-residents to keep detailed records of their rental income and expenses to accurately report their financial activities to the CRA. Claiming deductions and tax credits. Non-resident landlords can claim deductions for various expenses related to their rental property, such as property management fees, maintenance costs, and property taxes. By deducting these expenses from their rental income, non-residents can lower their taxable income and potentially reduce their tax liability in Canada. Additionally, non-residents may be eligible for tax credits under certain tax treaties that Canada has with other countries. These credits can help offset any taxes owed on rental income earned in Canada. Compliance and penalties. Failure to comply with Section 216 tax requirements can result in penalties and interest charges imposed by the CRA. Non-residents who do not report their rental income or file a Canadian tax return may face consequences such as fines, additional taxes owed, and possible legal action. It is essential for non-resident landlords to understand and adhere to the tax regulations set forth by the CRA to avoid any potential issues. Seeking professional assistance. Navigating the complexities of non-resident rental income tax requirements in Canada can be challenging. It is advisable for non-residents to consult with tax professionals or accountants who are familiar with Canadian tax laws to ensure compliance and optimize their tax situation. By seeking professional assistance, non-resident landlords can minimize their tax burden and avoid any pitfalls associated with non-compliance. Conclusion. In conclusion, non-resident rental income tax requirements in Canada, particularly under Section 216 of the Income Tax Act, play a critical role in ensuring that non-residents fulfill their tax obligations while maximizing tax benefits. By understanding these regulations, keeping detailed records, and seeking professional guidance when needed, non-resident landlords can navigate the Canadian tax landscape with confidence and compliance. Get expert guidance on Section 216 filings. Call 406-283-874 or visit theaccountingandtax.com.